Today's presentation, we're going to be looking at Fibonacci trading for high probability trades. Please take a moment now to have a look through the disclaimer. This presentation is educational in nature and that no personal advice will be provided. As you know, with trading contracts for difference and foreign exchange, your risk is, using leverage is high, where you may magnify your wins, but also your losses, and that you may exceed, losses can exceed your initial capital that you deposit. So if you have any questions on this, please don't hesitate to give us a call. Okay, so Fibonacci analysis, what is it and how can we profit from it? So the Fibonacci analysis, you see it all around us, and it's derived from the number sequence that you can see on the side there. So by looking at, 1 plus 1 equals 2, 2 plus 1 equals 3, 3 plus 2 equals 5, and so on and so forth. That's, that's where you start to see that sequence develop. And the Fibonacci sequence was discovered by an Italian mathematician, Leonardo di Pisa, where in the sequence, each number is the sum of the prior two numbers, and each number is approximately 1.618% greater than the preceding number. So as you start to get high, you start to see, pretty much just times 1.618 by the previous number, and you'll start to see those numbers develop there. So, like these Fibonacci analysis, you can see it come up in nature all around us. So if I have a quick look at these ratios that appear around us, you can see hurricanes, as they develop around these Fibonacci ratios. Galaxies, you can see the swirl there. It's, it's the proportions are within that golden mean, that 1.618 mean. Donald Trump's hair, so it was either between Donald Trump or the Mona Lisa. I figured Donald Trump. He's he's in the news a lot lately, and and you can see his hairline is is perfect, a perfect match to the Fibonacci ratio there. I've also got a picture of a Ferrari here where you can see all the proportions are within that Fibonacci ratio. So it's something that comes up over and over in nature. Plastic surgeons use Fibonacci ratios when they're looking at patients' faces or whatever their procedure that they're looking to do. Engineers use it, architects use it if they're working on a major project. So these things, these ratios appear over and over and over. And if we go back to the actual number sequence itself, you can see 1, 2, 3, 5, 8, 13. This is the number of, when it starts to branch out, this is the number sequence that it follows. So today what we're looking at is Fibonacci trading, identifying the key ratios, in both strong and weak trending markets, Fibonacci applications, looking at, Fibonacci retracement levels and extensions and how to use that. So, what I want you to get out of this presentation is, having the confidence and the skills to be able to identify swing lows, swing highs, and to be able to draw these levels. Okay, so these are some of the things that I'll be going through, and I'll show you lots of examples so that you get comfortable with it. If you're, if you're registered for this presentation, you're attending tonight, then, we'll send this out to you as well. Having a closer look at extension techniques, because this is something that I use quite extensively to find once I'm in a trade on a Fibonacci retracement level, for example, I then need to look for a potential profit target. So I look at direct Fibonacci extensions, Fibonacci price projections, and I'm going to focus on one particular extension level, which is one of my favorites, and it shows up over and over and over. So we'll go through that a bit later on. Fibonacci confluence. So once we have the ability to be able to draw Fibonacci retracement and extension levels correctly, what we start to do is we look at Fibonacci confluence levels where, if we apply a Fibonacci retracement on a particular range, then we identify a Fibonacci extension on a move down, and some of these levels line up. That's an area that I get very interested in. I know a lot of traders do as well, because it provides very strong support and resistance levels. So we'll have a look at some examples there. We'll go through a Fibonacci trade setup, and lastly, what I want to finish off on the platform, we'll have a look back at 26 where a lot of these Fibonacci levels appeared. So I saw a lot of them come up on during Donald Trump's victory over Hillary Clinton. We saw on some indices there were 7% swings. If you're trading that without knowing any of these levels, it could have been quite scary because you just don't know where the market was going. There was lots of tweets coming out, articles that were saying, oh, Donald Trump's in, it's the end of the world. And then next thing you know, once the market sort of reversed and started to head the other way, the tone completely changed. Oh, actually, Donald Trump, his policies are reflationary. They're actually quite bullish. And then you start to see the market go through that, huge run up from, when he was announced the 45th president. So we'll have a look at those. These are the key ratios. So Fibonacci ratios are derived from dividing the numbers in the Fibonacci sequence. So for example, 89 divided by 55 gives you 161.8. This is called the golden mean. And if you take the inverse of that, it gives you 0.618%. So looking at the ratios, we're going to focus on these key ones here. And these ratios are available on your Fibonacci tool as well. So the 23.6, 38.2, 50%, 61.8, 78.6 retracement. And then we'll also look at the key Fibonacci extension ratios, 127.1, 161.8, 261.8, and 423.6. If you have a look to the right here, these are how the various ratios are derived. So once you have the golden mean and the inverse of it, so the 161.8 and the 0.61.8 or 8, you can start to get all the other numbers that are displayed here. Now, a key note is the 50% retracement isn't a Fibonacci ratio, but it is something that a lot of traders look at. WD Gann use it quite extensively, as well as a lot of other trading systems that I've found over the years. The 50% mark is often a place where if you have no inkling for technical analysis, but you're looking at a particular stock, it comes back halfway. Fundamentally, it looks good. Generally, you start to see buyers go in there. So, it's just one of those ratios that shows up over and over and over. And yeah, and it's a key one that, that I like to look at as well. So Fibonacci ratios, key Fibonacci ratios are generally the 50% and the 618.8% ratios that I'll look at. So how we find these ratios, these pullbacks, and how we draw it is by identifying the swing low that I've marked here as A, then the swing high at B, and then pulling it down to C. So this is what I often like to look at. Once we have this particular range, then we can start to work out, okay, if it hits any of these ratios, that's when I start to get ready to enter the markets once I get a confirmation. So whether it's a pivot candle, whether it's a price, going above a short-term, moving average, whatever that may be, it's these levels that we have, in front of us. They're levels that we can use to plan these trades ahead of time. So you can see this particular example, the Fibonacci ratio got to the 38.2, sort of hesitated there. Next day, gap down, didn't quite hit the 50%, and it started to rally up. Now, this down move isn't over yet because this swing high back here hasn't been taken out yet. So if this is the start of the next move down, then we could start to see this 50% level get tested, even the 61.8% level get tested, depending on the move. So, with Fibonacci analysis, one of the things that I want to quickly dispel as well, that is once you start applying this, you're going to see price hit it precisely every single time. It doesn't happen. I've been using this for over 10 years. I see it happen a lot of the times, not all the times. And, you start to train your eye and go, okay, these are the levels that I want to look at. These are the levels that I want to start to, buy in or sell into. It doesn't have to always hit it exactly. If it does, great. If it doesn't, it's still an area of interest of mine. So when you start to apply this, don't expect it to hit it exactly 100% of the time because it won't happen. Excuse me. So for short trades, we just do the reverse of that. So identify a swing high here at A, and then we identify a swing low here at B. Market comes back. It pulls back to the 61.8% retracement before coming back down. So very, very simple when you start to get used to it. You need to be able to clearly identify on the chart which one's a swing high, which one's a swing low, and then apply the Fibonacci tool to that. Okay, so in strong trending markets, generally what I'll be looking for is a pullback to the 23.6 retracement level or the 38.2 retracement level. So if these two levels, and I can see it's a really strong up thrust in a particular market, a lot of bullish candles, then I'm only looking for a shallow pullback. And my strategy is to either buy on a break of this point here at B or look for a shallow pullback to get in and try and ride that momentum up, because it happens quite often. And if we have a look back in time, some of the biggest rallies, if we missed it, then you've missed it. If you're looking for a deep pullback, you need to adjust your strategy and go, okay, I'm going to buy on a breakout of a previous high, or I'm going to get in on a shallow pullback and set my risk management levels accordingly and then try and ride that up. So here we have an example of a downtrend where we've got our swing high here at A, then our swing low here at B. Price tested it twice. It came back. You can see it tested it here initially, came here, came back up. This little tail here, I sometimes almost like to see those show up on Fibonacci levels, because what it's shown me is that these larger players in the markets, whether they're the large market makers, hedge funds, large institutional traders who can see a lot of client flows, who know where a lot of the weak hands are. This is them basically trying to flush any of the weak hands out and then get in on this downtrend. So you can see it's flushed them out. The next candle there, bearish, it respected that 38.2 pullback, and then we started to move down. So when I see that, that's my trigger to go, okay, it's done with trying to triple these weak stops, and then it's time to start to move down. And what I would like to you do is when you start to apply the Fibonacci retracement ratios, have a look and see how many of these you see and how many follow-through candles do you see it sort of test it with that long wick and test it a few times, or do you sort of see it test it once on a particular instrument that you trade and then it starts to continue on its trend. So just some observations there. It doesn't have to hit exactly, and there's reasons for that, and it's often traders, larger traders in the markets, larger players trying to trip out these weaker hands. So in weak trending markets, what I often like to look for is the 61.8% retracement get hit or the 78.6 retracement target get hit. So again, you can see we need to identify the swing low here at A, then the swing high here at B. The idea here is to buy on a pullback, so we're waiting for a particular retracement level to get supported. You can see it's hit the 61.8% retracement, then it's come back up. As soon as I see a candle like that, then I'm like, okay, if 61.8 holds, I'm going to look for a buy entry. And then you can see it recovers and it starts to head higher. And again, this didn't respect, it didn't hit it on the dot. It got close to it, sort of punched through, and then it started to head back up again. Now, on this particular chart, you can see we've got a swing high here at A, then a swing low here at B. The market pulled back right past the 78.6 retracement. So these chart examples I've taken from intraday charts because I wanted to show you and give you a bit of context. You often find these deeper pullbacks occur either when the market's very volatile on a daily, weekly time frame, if we see like very strong sell-offs, or on an intraday basis where if there's a news announcement or if there is that high periods of volatility during the Asian European session crossover or the European and US session crossover. What you'll often find is these deeper retracements get respected, and you want to see what the candle stick patterns are exhibiting around those levels. When you apply Fibonacci, and this is a key point to note as well, I often would advise clients to apply Fibonacci analysis on either bar charts or candlestick charts because it gives you the absolute highs and lows on the charts. Whereas if you're using a line chart and if it's based on a closing price, then you're not going to get the exact level. So you need to keep those in mind. So if you traditionally just trade with a line chart and you're using Fibonacci analysis, that's fine, but also maybe try putting on a candle or a bar chart and see the difference. See if you are getting better reads and better levels getting hit on that. Just one other pullback that you may see, which is 100% pullback. So if the market does pull back 100% of the range, then that obviously becomes, classical double bottom or double top chart pattern. These often are exhibited in markets where, it's very undecisive, it's very news driven, and, or it could be during a period of low liquidity as well, where you start to see some big orders come through on some news that the market just isn't prepared for. So keep those in mind. These are the key ratios when looking at a weak trending market. If we have a look at extensions now, please excuse the spelling mistake. I just noticed that then. We're looking at, the 127.1%, 161.8, 261.8, 423.6 extension levels. So to draw, to apply the actual extension itself, what you want to do is draw a swing, draw the Fibonacci ratio from the swing low here at A to swing B, and then look at what the expansion levels are. So these extension levels here at 161.8 hit quite nicely, almost to the point, and then price, when it broke out of that previous swing highs here, then it went for that 261.8 retracement extension. So you can see, these ratios, they appear over and over and over, and I'll show you some of these when I jump onto the platform. What is a valid extension is what I'm looking for here. For this to be a valid extension, I'm looking for a low, then a swing high, and a pullback to at least a 50%. It can be 38.2 or 50%, even a 61.8% range. So you can see move up, pull back. Now we apply the Fibonacci extension, and we can see these are the levels that we'll be going for. So if it's in a nice, strong trending market, then I'll be looking for, a tier 1, tier 2 target. If it's in a not so trending market or I'm undecisive, then I'll be going for just a 161.8 market, and even just or bringing down the tier 1, tier 2 to focus on the 127.2 extension, and then T2 at 161.8. But, a lot of these levels, ahead of time, and you can adjust them accordingly. So Fibonacci price projection, so this is different from the extension. You apply it in the same manner, but we just do something slightly different. So there's two steps it is. Similar to the Fibonacci extension, we need to identify a swing low, then a swing high. Once that's in place, then we're looking for that, that pullback to point C. Now, once we have that, the Fibonacci price projection comes in when we actually move this range from AB, and we move, can you see how this is 0 at A? We want to move this range to C, so then that pushes it up. And you can, from this example, you can see once we've moved that, this is now that 100% extension from point C. So, this particular Fibonacci price projections, it's something that I often use when, if the extension levels get exceeded, then I move that range up to point C to find, the absolute high where I think the market may go. So, there's a bit of art to it as you start to use this over time, where, if particular levels get exceeded, then I move to the price projection method. So if I get a price projection lining up with a Fibonacci extension and a retracement, so I'm talking about Confluence now, then that's going to be a very, very high, support or resistance level that I look at. Okay, so Fibonacci price projections on a short trade. So again, looking at a swing here. So we've got here a swing low at A, swing high at A, swing low at B. We identify here at C is that point where we're going to make the projection from, and this hits it quite nicely. So that range AB from point C, we saw 161.8 extension get hit, which is the golden mean, and this is a level where if you're short, good area to take profits. If you're counter trend trading, this could be a good area to take a long scalp. Okay, so now a little bit more on the 261.8 direct Fibonacci extension. So this is one of my favorite ratios that I look at. I often use it more on an intraday basis, but if I look at it on the daily chart and that level gets hit, it is something that I'm very confident in taking positions on. So, a lot of this too, it's taken a long time to sort of, develop systems around this and actually get confident and actually strip away a lot of the stuff that you don't need. But once you start to see it and these ratios hit over and over and over again, that's where you start to build confidence, and that's when you get more confident in your trading and you don't really have that hesitation to pull a trigger. And that's what I find with my trading. Once I sort of unlocked that hesitation, trading just went to a different level. So, that's what I'm hoping that, if you can incorporate some of this analysis as part of your current trading, if you like using indicators, and I still use the RSI, but slightly differently, but I use it in conjunction. If a fib level gets hit and the RSI show me an overbought, oversold level, then that just gives me that added confirmation. But the RSI isn't my primary tool. It's just more of a confirmation tool. So, sorry to digress, but just to jump back onto the 261.8 extension. So if we have a look at this level here, I found this swing low here at A, swing high at B. We found, it's pulled back to around the 38.223 level. Okay, we're happy with that. Let's apply the extension. Now you can see the first level that it hit, 127.2, kind of pushed through the 161.8, but as soon as it hit the 261.8 extension, tested it almost 3 times before it pulled back quite aggressively. So, this is a level where if it hit here, I'm trading short. If it hit here again and then sort of incorporating classical chart patterns, double tops, etc., that's going to give me a double confirmation that, this is an area of very strong resistance. If my RSI is giving me a bearish divergence, for example, then, that just gives me that added confidence to go in on that particular trade. So, if you're looking at doing this for short trades or in a downtrend, then just do the opposite. So find that first range, expand it out, and look for the 261.8 extension level. Okay, so Fibonacci confluence level. So now that we've got a bit of an idea of the different types of Fibonacci retracement and extension levels that we can apply, now looking at confluence levels where, some of these levels may intersect. And when you start to see these happen, this is when you start to see Fibonacci really come into the fold. You start to see these very powerful, resistance and support levels, and the different combinations that you might find retracements, so using multiple swing lows from a common swing high, retracement and seeing an inverse price extension going into a retracement level, retracement, inverse price projection, price extension / price projection. So looking at an extension and then a price projection going into the same level, that can give you, a key turning point there as well. So what I want to do is just quickly show an example of how we can use Fibonacci confluence levels and how it applies. So I've got this move here. I've labeled it capital A for this primary swing low, lowercase a for this minor swing low, and then I'm gonna draw it from a common swing high here at B and B, lowercase b. So the first one here at the major swing high, you can see I got it from this low here at A all the way up to B, and you can see the market pulled back to the 61.8% retracement here at C. Okay, so for some traders, that might be enough to go, okay, you know what, I'm going to get in on that trade. But for other traders, they might apply another fib retracement, so from this minor swing low here at A, and it's actually hit the 78.6 retracement now. So if we put them together, this gives you point C here, which is a very, very strong support level, where if I was trading that and I saw those two levels get hit, that's going to give me a lot of confidence in waiting for a confirmation candle to get in, set my 1-to-1 risk to reward ratio, and then expand that out if the market starts to move in my favor. So what we like to see here is obviously these pivot candles form, and if you're in the Monday morning webinars, we talk about those pivot entries quite a fair bit once certain levels get hit. So we always want confirmation when we enter on the trade, and these levels once they hit, and I know this particular move too. If you draw a trend line, it's sitting on the trend line quite nicely as well. So you've got multiple confluences of indicators and Fibonacci levels. Excuse me. Okay, so here we have, so this is what I like to use as my triggers to get in on a trade. So once a Fibonacci level has been identified, I'll watch the price action. So the price action, let's say it comes down, hits a fib level, this becomes a pivot candle, the pivot is formed, and we start to see the market start to head higher. So you want to enter in on, depending on how experienced you are and how aggressive you are, you can enter in on the high of that pivot candle, or you can enter in on the open of the next bar of this particular white candle here. You basically do the opposite for, a top here. So if we're looking to go short, then we're looking for a lower high, high, lower high. Pivot's been created, then we've got our entry signal here. Okay, so let's have a look at a Fibonacci trade setup. So first thing we want to do is identify our trading bias. So looking at the chart, what do we want to do? Do we want to buy on a pullback? Are we counter trend trading? Are we fading an impulse move, shorting rallies? What is it that we want to do? So once you got that strategy, if you just want to buy on a basic pullback, then great. We know we're just going to be applying Fibonacci retracements. Look for multiple Fibonacci retracements to identify confluence levels before we get in. Then that sort of gives you a bit of an idea. So it's always you start off with the bias and then you plan your strategy around that. Next step is apply the Fibonacci analysis to the swing highs, swing lows to identify the entry levels. Do any confluence levels exist? So, being able to find multiple, combinations of, retracement on retracement, retracement on Fibonacci extension, whatever that may be. If the question is yes, great. We've got a level that we want to enter in. So what we want to do now is, if the price reaches a Fibonacci entry level, then wait for a pivot candle to form. So what I often do is, and you need to look at what type of time frames you're comfortable with as well. If you do your Fibonacci analysis on a 4-hourly chart, for example, I might drill down to a 1-hourly or 15-minute chart to try and get a very tight entry. So I'm looking at, okay, hits the fib levels on a 4-hourly chart, quickly drill down to a 1-hourly. Okay, it's still looking okay. It's respecting that level, drill down to a 50-minute chart. And I'm looking for that pivot candle to pivot entry to form before I get in. Work out your stop level and calculate risk. So we always want to have our stops in place and a potential profit target to make sure that the trade is worth it. It's not worth it if a trade is, we need to risk 3 to order to gain 1. That doesn't make sense. We always want to go for 1-to-1 or greater. Now, this here, I'm just going to read it out because it's quite important, because the next example that I'm going to show is going to show you what I mean by the 261.8 direct extension of the first wave up. So initially set a 1-to-1 risk to reward ratio, and then use the Fibonacci 261.8 direct extension of the first wave up to extend profit target to improve the risk to reward ratio. So what that basically means is, we're in the trade, and the trade's starting to develop, and it's respected that particular entry level and that fib level. We start to head up. Now, as soon as we see a little, that little first wave, that little initial pullback of that move up, I'll apply the Fibonacci tool to get the 261.8 extension, and that's going to be the level where I will move my profit target to. So once you've done that, let the trade develop. So, we want to make sure we maintain our discipline, we sit on our hands, and we try not to close the trade out early, because I find that that's often what happens to a lot of traders, is that, once they're in profit, sometimes you don't see a profit for a long time, after a string of losers, you just want to close that out. But if we do that, mathematically, you're probably going to just grind the account down to a level where you need to top up again. So what I suggest you do is test this out on a demo account or a live account on really small trade sizes, just to let it run. So because I often find that traders who often close out positions early is because they've got the incorrect position sizing. Therefore, as soon as they see a profit of a particular value, they're like, oh, that's a good profit, let me take that. But if we took that dollar value out and we saw it, whether we're measuring in pips and all that sort of stuff, then you might say, oh, why did I cut out of that so early? Clearly the market's going to head higher. So you want to try to remove that emotional side of it when you position size. So yeah, so let's have a look at this example. This Fibonacci trade setup that I'm looking at is just buying on a basic retracement. So we've got a long bias here. We want to buy in on a pullback. Initial risk reward 1-to-1 ratio. So we've identified our swing low here at A and our swing high at B. Apply the Fibonacci retracement from swing low A to swing high B, and that's going to give us our levels ahead of time to see, which levels we want to get in at. Okay, so what we find now is we've applied the Fib retracement. It pushes through the 61.8% retracement. Now we're looking for the 78.6 retracement to hold. And again, remember how I said the prices don't have to hit exactly, but they'll get close sometimes, but they don't have to hit exactly. So as long as it gets into your to a particular retracement zone, then we should start to look at it and go, okay, we're interested now. Also keep note that you can see there's a lot of resistance here, resistance then becomes support. So you can see why it never really quite hit this level. Now, this is another trick that I use with Fibonacci analysis, because when you draw retracements, depending on how you apply it, so how you drag it across, you often notice here, and if you've been noticing this in some of my slides, I congratulate you, good attention to detail. You can see here, swing low to high, but I've got here 0 to 100%. If I flip that around, I'm going to have 0 here, 100% there. I've got the 23.6 retracement here. So what I often do is, if I don't get exactly on the 78.6, I'll quickly flip that to get the 23.6, which is slightly lower than the 78.6, just to give me that little bit extra to see, okay, is the price going to just touch that and then go up? That's something that, sorry, I should say it's 23.6 is a little bit higher than the 78.6. And I'm just looking at that to just give me that, okay, it's touched that, yep, it's valid. Let's have a look at the trade. Let's look at our level to get in on that trade. So now what I'm going to do is apply both of them to the chart, and you can see I've created a buy zone here now, and it's hit the 23.6 retracement. Okay, great. Let's start to wait for a pivot candle to form. I want to enter now on a break of the high of this candle. It does that on the next bar. We enter the trade. We place our stop below here. I don't want to put it right below the low, but I want to put it below the 78.6 retracement, because that's going to give me a bit of peace of mind, a bit of comfort. Set my initial take profit at a 1-to-1 risk reward ratio. So this is an area where we're looking at now to take our profit. But the next step is, what I want to do is I want to wait for a pullback of this first wave. So here we've got the low. We've got the swing high here at this candle. You can see it's come back to the 50% level. Now what I'm going to do is I'm just going to run a direct expansion of that. And sometimes I do this on so if I enter in on an hourly chart, I might zoom down to a 15-minute chart to just see that particular up move develop and look for that first wave up. So once you've got that first wave up, it's come back to the 50% pullback. We extend that out. This now becomes a new profit target. And on this next example, you can see the 261.8 hit exactly before it reversed. So, that's how I like to set up a lot of my trades. Once I'm in on a pullback, drill down a time frame, market starts to move up, pulls back, apply the 261 or apply the Fibonacci extension in search of that 261.8 to improve my risk reward ratio. Now, by all means, you can split your position up where you might leave one position, so it's got a 1-to-1 risk reward ratio trade, and then once that hits, great, but then the second position, your T2 on the 261.8. So effectively what you've done is you've given yourself a free trade there because you've already made that risk up on that first trade because it hit a 1-to-1 risk reward ratio. And then that trade that you still got in play, you can even move that stop to break even or trail it up on any, the low of the previous bar, whatever techniques, parabolic SAR, moving average, whatever that may be. But there's a lot of ways in which you can sort of do this. This is just how I do it, and I just wanted to give you a basic template from you to work on and, sort of make it your own. And yeah, and it's something that I see happen over and over. I'm just repeating the same process. It can become monotonous, but, that's trading. It's not supposed to be exciting if you're doing it properly. If you're doing it properly, I think the exciting thing is what you can do with the profits that you have after, so. Let's have a look at some of these examples on MT4. So let me switch over to the MT4 platform. Let's have a look at the Dow Jones. So with the Dow Jones, what we want to do is, if I'm looking at this chart here, I've got some pullbacks. Let's apply the Fib tool. This level here. So all I'm taking this swing low here at this candle up to this swing high here, and we can see it came back to that 61.8. Now, some of you might say, no, that I wouldn't enter in on that. This is when we had that really big push down in June, and then we start. I think this was Brexit actually, and then we start to see the market recover. Now, what I'm going to do now is look for a confluence level. So from this high to this low, because I can see it pulls back around that 50% plus mark. I'm going to apply that level there. Let me just adjust that. Okay, it's on that low. You can see now, let me just move that in so we can see that a little bit clearer. You can see now we've got a confluence level here where we've got 61.8% retracement that we knew ahead of time from April, and this low was printed on just after 25th of June, and then from taking the direct expansion from here back in April, expanding it out from mid-May, we had this level that we identified ahead of time. So if we were watching Brexit and everyone was expecting a no vote, then all of a sudden the yes vote came in and the market just tanked, we knew this was an area where the market was going to turn around. There was a high probability of it doing it here. Now, if this level didn't hold, you can see we've got another area of confluence here as well. So that would have been another area that would have been quite interested in, going long if it hit that level. Okay, so you can see ahead of time we knew some levels ahead of time where Brexit might have came into play. Let's have a look at another low. So I'm going to take the absolute low here because it's the lowest one that I can see on the screen, and I'm going to just drag it up. And so what we're looking for now is you can see this hit quite nicely, but we already knew this low ahead. I'm taking it actually up to this swing high here because I'm looking for potentially where the Brexit low might have hit. So if I move across here, it got quite close. It didn't get here exactly, but it got quite close. But you can see these other pullbacks, it respected 23.6 quite well. So what I'm going to do now is potentially look for a confluence level because we've got a swing low here. Let's apply the Fib to that level. So again, we can see this area here was an area of interest. Now what I'm going to do now is do the direct range expansion from this high to this low. So let me grab that. Okay, so now you can see these levels, all three are intersecting around this level here. So keep in mind that, the Dow, on the futures market may have got close to that level, but this is an area where, if we were looking at it, it would have been an area of interest, definitely. Okay, if we have a look at the S&P, this here was a very interesting chart. So if I apply the same ratios, So again, looking at Brexit, we can see hit 61.8, came down a little. Whoop, let me just bring that down. Came down a little bit. So we knew ahead of time if it was going to pull back, this is an area of interest. Now I'm just going to move this up here. So this is a longer term fib retracement. So I've adjusted it now so that we've got a low point here to the swing high. We're looking for this particular pullback. Okay, so it didn't hit it exactly, sort of pushed through, but we had this level in front of us. What I'm going to do now is just adjust it to this swing low. Okay, and you can see it got it almost exact. Now, remember how I said if it sort of punches through the 23.6, I'm going to flip this now to get the 78.6 retracements, and let's see if that holds. So I'll flip that now, because remember I'm trying to find that buy zone, and look at that, it hit it almost exact. So at this level, we knew these levels ahead of time. So we've got here June, so the Brexit low here, then that rally that we had after Brexit, so those highs here back in August, and then that pullback, and then Donald Trump, the low here, we found it at this level. Okay, so this is something that this is on a daily time frame too. So as I mentioned to you earlier, I look at a more shorter time frame to get in on a lot of these trades. So but I do have a lot of these levels set up as alerts. So if it does hit these levels, I'm going to be watching the price action, because I know it's something significant, and I know it may not be that valid on a daily or weekly chart, but on an intraday chart, like a 5-minute, 15-minute, hourly chart, you'll often see that initial touch, you'll see that bounce. But if the momentum is quite strong in that particular trend, then you'll start to see that particular point will get taken out. But I'm always looking at these levels because I'm trading on a shorter time frame. They often work very nicely when they do hit. Okay, so if we have a look at the DAX, for example, so this is let me zoom out. So we've got the DAX here. Let me have a look at. I might just zoom in a little bit more. Just let's focus on October on the DAX, because we can see it was sort of stuck in a range a little bit. So what I want to do is I'll just zoom out. Bring up October. Okay, so I'm going to apply. So I've got this low here. Here's a fib that I've drawn from this low in June to the rally that ended approximately, actually I can probably move it up a little bit, in August, and then again it tested it in, actually I'll just move it here initially, because you can see here, as we've already identified the fib levels, and you can see the first test, it hit this level. And it came back up, and it came back down, and it actually went through that. Now, what I'm going to do is try and find a confluence level to find this particular low. So if I draw that, so what I've got now is a confluence level around this 50% level. Doesn't hit it quite exactly, but it got quite close. And again, drilling down to a intraday chart, you'll start to see the pivot candle setup form, and that could have been an entry there. Now, the other thing that you can do is, so I'm taking a direct expansion from here to here. I'm going to take the reverse, and it gives you a very similar level as well. Okay, so this is on the DAX. We have a look at the FTSE, for example. The FTSE is another example where you see these ratios come up quite a fair bit. So if I move this down, if we were looking to go long, for example, this 61.8% level was a level that, it got quite close to testing, and then we start to see a move up. Now, if we So what I'm doing now is running an extension of this range here. Okay, so this extension of this range, because it's shot up, come back, we want to buy on a retrace. You can see hit the 23.6 quite nicely. If we do the reverse, for example, because you can see it's sort of dipped below that, and I'll see if it respects the 78, which it does, almost exact. If I zoom in a little bit, move that up. Okay, you can see it's come down to around that buy zone that we identified. So we've got 23.6 and the 78 giving us that zone. Gets in here and we start to trail our particular move. So if I also apply that same analysis, I'm looking for that first wave pullback. In this case, I'll stick to the daily time frame. I'll move it up here. It's hit above the 261.8 and we've got the 261 up here as well. So 161.8, blasted through it, and then we've got the 261.8 up there as well. So if you're looking to trail that. Okay, let's have a look at the Oz 200, for example. So this particular, I find on our local market, the fib ratios come up quite a fair bit. So if we have a look here, so I'm taking it from this swing low to that swing high. You can see it's hit the 38.2 quite nicely. Let me just bring it in a little bit so I can see it. So you can see it's hit 38.2 quite nicely. Now, if I now apply another, so we're looking at retracement confluence levels, it's hit this level again quite nicely. Okay, so you can see, okay, great. These fib levels are hitting quite well. Now let's see where this one ended up. So if I now, I'll still take this swing low and I'll move it up here. Okay, so it's hit it initially on the 61.8 extension retracement. So hit here initially, bounced, we had a nice bounce there, and it's come back and it's tested it again before going up. Now, what I always do is obviously not just to rely on one retracement, I have a look at the next one, and we want to see where our buy zone is. And this is a good example of it not hitting it exactly, but sort of pushing through it a little bit. But we know that this is an area where we want to get interested in potentially buying. Now, I've just applied retracements there to identify that area. If I do a direct expansion, okay, you can see 2618 actually ends up down here. So it's an area that you can still sort of see doesn't quite hit it during trumps, but you can see it's an area where this ratio, depending on when you apply on an intraday basis, you see it happen quite a fair bit. But equity markets generally, when we're bullish, we're not going to see these really deep pullbacks. So let's have a look at some other examples. Let me just take this out. Okay, so again, just taking it from this swing low to this swing high, right on the 78.6% retracement, and then we move up again. If I drag this now, so I'm going to use this common high here, I'm just going to drag it down to this low here. Again, we've got the 61.8 retracement right there. If I drag it here down to this low, we've got the 50% mark. So this potentially has given the strongest, support reading here. Just purely by applying the free fib levels. So I'm just going to draw it, just overlay it on each other so you can see. So all of these just ended up here. 61.8, 78.6, 50%, all at this level. We saw it hit and then reverse. So, these levels we knew ahead of time. From this swing high here, we knew where this potential strong confluence level hit. So this is stronger than this one here, because this one, it's almost exact, every single level lined up. So again, on the Oz 200, this is a market that I find you often see, these levels hit quite often. Okay, so now looking at, so if I start on the Oz 200, we're getting a lot of questions about this. If I sort of expand this out here, 161 got hit. I like to see if we have, if this, the price action here, so we're sitting pretty much, I'll move this down a little bit, on this previous resistance now becomes support, where we're seeing, it's sort of, again, resistance becomes support. If this level holds, I wouldn't be surprised if we start to head up here to this level, because I'm doing a direct expansion of this move, this current move up. If we hit that level, this could be an area where we might see a bit of profit taking come in. Okay, so something to keep an eye on. What I'll do is I'll finish off on gold. So gold was, during one of my first presentations, I sort of outlined some areas that I was looking for on gold, and all I did was ahead of time I knew which, if gold was pulling back, which you could see clearly here, it just kept pulling back, pulling back, pulling back. Down here again, what I'll do is do the inverse of that, and I'll bring that in a little bit, and you can see we've created our buy zone here, because it's both on the deepest ratios. It's hit that, respected it. This was a level that I was looking to buy into. So yeah, so ahead of time we knew, just applying the fib from June, these were the levels of interest to get in at. I was, a couple of the gold analysts that I follow, they were calling this level. Once it broke, they're like, nah, it's gone below 1,000. I was still watching this level here, because there was a lot of interest still in gold, trying to find a bottom. And if I just run an extension, so what I'm going to do is a Fibonacci price projection now. So I've got this here from swing, let's say point A to point B here, and I'm going to project it from this move here. So once we got that, again, it's within that buy zone area. So that was an area that I was looking at for potential reversal. Okay, so this is some ways in which I use the Fibonacci, using a combination of direct expansions, then looking at price projections. But the most common tool is just Fibonacci retracements. Looking at where the market pulls back at, because it's the easiest one to apply, because you can easily spot. I've got a swing low here, got a swing high here, came back to the 38.2, shoots up. So if you know these levels in advance, it just makes your job a lot easier to be able to identify these levels and act on them. Okay, so I'm seeing a lot of questions about no sound. Do apologize for that. If you have any questions or any particular instruments that you want me to bring up, I'm happy to do so. I'll probably do that for the next five or so minutes. Okay, so okay, oil please. Yep, no problem. I'll have a look at oil. Okay, so I've got a question here. Do you utilize volume on pullback? So if I was trading equities and futures, yeah, absolutely, volume would be a consideration, because what you would like to see is an increase in the volume at those areas. In particular, if you start to see a bullish candle print, then what that's telling you is if there's increased volume on that particular bar and it's a bullish candle, that's telling you there's more buyers in control, or more the bulls are in control effectively on that particular candle. And that could be that reversal that you start to see a lot of short covering, and you start to see a lot more, bulls start to get interested in again on a particular trade. So this was, again, if I just quickly jump onto gold, clear example. Like, I guess if I had access to, CME data just to see gold futures contracts, I reckon around this area we would have seen a spike in the volume there. A lot of accumulation would have been happening here. You can see this level held. They're trying to sell down. The bears are trying to go down. The bulls are like, no, thank you. I'll keep buying. I'll keep buying. I'll keep buying. And eventually you start to see it break up. This bar that you can see here, this is telling you that all the weak hands, all the guys who were short ages ago, they're now closed majority of their positions. All the guys that got in late, they're getting stopped out now, and you start to see the price push up quite quickly. And then gold's just pretty much been on an absolute tear since early this year, late last year. So for gold, I still want to see it head up to this trend, this longer term trend line that we've got drawn here. I feel that if gold starts to get a little bit of legs, and technically, it's pulled back to a retracement, so it hasn't broken this swing low. So naturally, I think a lot of traders would like to see this push up. Even if it breaks above this, pull back down, find support here, and then push up higher. So that's gold. Let's have a look at oil. Okay, because I've done some prior analysis on this, let's have a look at a weekly chart. So oil, for example, it's come back and actually hit the 50% retracement. So from this low here up to that high there, you hit the 50% retracement. You can see almost a textbook weekly candle there, and we start to see a move higher. Now oil is printing higher highs, higher lows, higher highs. We could see a higher low here before it starts to move higher, but it's just finding a lot of resistance along this neckline here. So we've got, I'll just move this down a little bit, sort of outlined potential head and shoulders there. So I'm still waiting for it to break, come back down and test and start to head up to potentially this 61.8 retracement area. It's got a lot of work to push through, but that's going to be an area where if we do hit that, and if you're long, then it could be an area where you might say, I might start to take something off the table there. But if it gets to this area, definitely an area to be of interest. I'll quickly apply. Okay, I've got the fib extension there. I might just do it onto this range. Okay, so this again, no confluence there, so just constantly just readjusting it, and now I've just done it from this low to that high. You can see it's right on the 50% level. 61.8 is sort of just sitting there, so not too much happening there. Let me just quickly do a direct expansion. Okay, so the direct expansion now from this low to that high, you can see 261 comes around that 50% level. So you know what, like this 50% level, and you can see there was two other fib levels that sort of intersected with that. Now if the price gets to that price level, that's going to be some major resistance. So if price breaks through that, it could pop to the 61.8 retracement. If it doesn't, and you've got the 200 period moving average as well, that could be a short-term high for oil before it comes back, accumulates, and then starts to head higher. Okay, so yes, what I'll do is I'll send out the slides as well to anyone who attended tonight. So I'll get that put together and have that sent out. Feel free to ask any questions. Now, just to sort of give you, because this is this presentation I'll put together sort of based around a lot of the feedback that I got from clients from the Monday morning webinars. It's very basic in nature in the sense that the whole idea of it was to give you that, that ability to be able to identify swing lows, swing highs, get used to looking at multiple Fibonacci levels on the chart without making it look too messy. So because that's when you start to identify the confluence levels, you're going to see a lot of lines there. But if you know what you're looking for, then you're just interested in these highlighted areas. They're the areas that you want to sort of start to initiate your trades at, and it's having that that ability to just apply the fib ratios on the correct swing highs, swing lows. Because once you've got that, the next step is it's something I don't use that much, but I do incorporate in some of my trading, depending on, especially on a more shorter term basis, but looking at Fibonacci analysis on the time axis. Because right now all we've done is just Fibonacci on price, but you can actually apply Fibonacci analysis on the time aspect. So that could be just, doing expansions between, swing high, swing low, but on the time basis. The other thing that I've looked into and actually incorporated as well is actually Fibonacci bar count. So when I hear the market has rallied 21 days, 21 is a Fibonacci number, I know there's going to be some strong resistance coming in, especially if that intersects with if there's a confluence of Fibonacci levels at that particular candle as well. That to me is, just market geometry at its best. You're seeing both time and price meet at a certain inflection point, and you're looking to sort of, take action on that, of course. So, these are the things that, once you sort of get an eye for it, you start to add more tools to your arsenal, and you start to apply the analysis, identify these levels, trading becomes less scary. But I have to stress, do not over leverage yourself on these positions, because yes, you might get quite good results in terms of, hitting a few trades in a row, and then you go, oh, okay, it's hit it again, I'm going to go big, and then that's the one trade where it fails, and you lose or you suffer a significant drawdown. So, some of those things, just keep that in mind. Okay, so just one last question. How do I define a strong and weak markets when applying Fibonacci? I generally just look at the price action. So for example, this move down on oil, that's a pretty strong move, right? So, if I'm applying the fib retracements, so let me just bring up a daily chart, might be a bit easier to see. Okay, so on the way down, if I got the right move, no, it actually starts up here. So if I'm on the way down, I'll just delete that as well. I'll apply the fib at this level, and remember how I said I'm waiting for a shallow pullback. So this here, I'm seeing quite a big move, and of course I'm taking note of if there's a strong run up, then we could get, a bit of a reversal. If it's starting to head down, I'm looking to, start to initiate some shorts now. So my two entry levels would be a pullback around this level, okay? Because remember, this is a strong trend that we've sort of looked at. So it's either buying on a pullback to try and get in on this downtrend, or selling on a break below of that low, and then just reapplying the same concept now. So now let's say we're in, we want to enter more positions. I'm just going to apply the Fibonacci ratio to this swing now. So going from this high to this low, again, we're looking for a pullback into this zone, and we can see it never pulled back much more than that, and we start to go lower. So it's just seeing how far it pulls back. If it pulls back and it's only a shallow pullback, then you're trading a strongly trended market. If it pulls back quite a fair bit, then that market is not as strong. But it's just one of those things that I've picked up over time, where sometimes you see these big runs on particular markets, like post-Trump winning, the equity markets just went on an absolute tear. If I bring up the so this is the UK 100 or the FTSE. You can see after Brexit, after Trump's win, the market started to head up. Is there anywhere we do not see any normal or deep corrections here? It's all shallow all the way up. So if you wanted to get in on this trade, you would have to pretty much buy in on any shallow pullback. So I'm doing it. I'm applying a fib from this low to that high here, high there, that retracement. Again, see how it never got to the 50% mark. It got to the 61.8 and then started to move up again. You know, and it just kept, and even here, I think once you sort of miss the boat here, for me, from a risk to reward ratio, because you just don't know what's going to happen after this, right? But, you know, just seeing these candles, they're trying to fake you out, but it just keeps going higher and higher and higher. This was 14 days, green candles. So when you see 14 days, 13 is a fib number, that's when I sort of said, yeah, we could start to see a bit of a pullback there. Okay, guys, I think that's it for the questions. I really appreciate your time today. Sorry for going over time. I'll let you know if I run an extension to this Fibonacci analysis webinar. And of course, what I'll do is I'll make sure that everyone gets a copy of the recording. We'll make sure we edit it as well so it doesn't include 20 minutes of silence. Again, I apologize for that. And of course, you know, the Q&A section at the end. So thank you for your time. Good luck with your trading, and please don't hesitate to give us a call if you have any questions. Take care.